All right, what is up, tycoons? What's up, traders? Super excited for today's video. We're gonna do another dive into TLT. All right, we're gonna look at TLT as well as a plethora of other things. All right, I've got some really good charts, data, information I want to show you guys. We'll take a look at a couple stocks as well in this video. So if you're here just for TLT, all you got to do is fast forward to about half of the video. Okay, that's kind of when I dive into TLT. Other than that, make sure to smash the like button, subscribe to the channel if you guys are new. We're going to jump straight into it now. And one thing that I want to really start off with over here showing you guys is take a look at how much people are overweight cash and underweight US equities, right? Hinting that a lot of this move to the upside, if you take a look at the volume, it's been relatively low volume. And the reason being is that most investors are overweight cash and underweight equities in the market. Okay, and you can take a look at this here. If you take a look at the cash, you can see it's very high. Okay, and then US equities is very low right here, right? And it goes into a plethora of other things as well. But that's really the main highlight, right? And this is the absolute net percentage overweight. So you can really see this is showing you guys, why maybe we're seeing not so much of a huge crash, right? If people are heavily positioned in cash, and I've spoken to people in the Discord who's recently told me that they just sold all their stocks, right? They just pretty much just sold their whole portfolio because the rally came and they're taking some profits. And a lot of people, there's a lot of uncertainty in the future about where things are going to go. And one of the reasons that people may be really overweight cash, all right, one of them is the core sticky inflation chart versus the Fed funds rate. So we have the core sticky inflation here in blue, the Fed funds rate here in red. And I know the banking crisis has really taken over, as well as interest rates, regarding treasury yields specifically. But when you look at this chart, okay, it really shows you guys and gives you a good visualization that inflation tends to stick around for a lot longer. And typically, we need to see the Fed funds rate get above the core sticky inflation, right? The Fed funds rate is here in red, and you can see once it's above the blue line, core sticky, that's when you tend to see a drop in core sticky inflation. Same thing over here, when it's above, that's when you tend to see a drop. Over here, Fed fund rate is above, and then you see core sticky inflation drop. And core sticky inflation really hasn't gone anywhere besides up, right? It started to move a little bit sideways, and the pace at which it's increasing is slowing, right? So that's a good sign, but we haven't really seen a sharp fall off in the core sticky inflation. All right. Now, this is core PCE here, the annual change versus the Fed fund rate. And, the market did rally here recently off of PCE news. We were able to actually capture that move and make some really great profits in the Discord, specifically just on Friday alone. But you can see that this is also starting to decline. But again, typically you see the Fed funds rate up above the core PCE before you start to see it drop, right? And that's something that we've seen many times in the past. And, we're not really there right now, guys. We're at a huge discrepancy when it comes to that. Okay. Now, full disclaimer, the content provided in this YouTube channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. I'm not a registered financial advisor broker, so make sure to read through the entire disclaimer. We're going to go ahead and get into it now and start diving into some charts. Specifically, we're going to start off here with Tesla. Now, we've been watching Tesla a lot in the Discord. It's actually got two bullish patterns forming right now. We have the much larger structure of the inverse head and shoulder, and we also have our cup and handle right here, okay? Now, we're on the verge of getting a breakout. If you notice here, I have fake out up here. And the reason I have fake out up here is because 217, even up to about 240 is really going to be fake out territory. And what I mean by that is we could have a false breakout. Okay. And ultimately, if we break this neckline back down to the downside, so let's say we get a breakout and then we go to retest this trend line, and instead of bouncing up for support, like a break and retest, a textbook break and retest, if we get a look above and fail, that's going to be very significant because essentially bulls are presented the full opportunity right here to really push Tesla up higher and try and hit those bullish price targets of 250, even all the way up to 300, on the opportunity on an inverse head and shoulders breakout, right? But if we don't get that, then all of this could be a liquidity grab, okay, where market makers essentially are looking to grab liquidity in this area, in these fake out levels, on a false breakout to actually push price lower. Because we saw earlier that most investors are overweight cash. So what happens here is, the bulls really have the opportunity to say, okay, I'm going to step in now with my cash, push price up higher to the bullish price targets. But if they don't, and if they remain overweight on cash and still underweight on US equities, then this could be a fake out, right? So you have to be cautious. You have to think about what would market makers do, right? What would big money, as they say, do to really fool investors, fool retail, and gather the liquidity that they need for their next move ultimately, right? So we are watching Tesla closely in the Discord. Here we have QQQ on the left. We have IWM on the right. Now I posted this in the Discord as well, last week, about a week ago. And what we saw was we had a cup and handle here forming on QQQ. All right. And we had this little overhead supply zone here with a bearish divergence forming on our MACD and our RSI. But we broke through the bearish divergence trend lines here recently. All right, and we recently just broke through our overhead supply zone. So if QQQ wants to keep rallying, I definitely think it could go up to about 326, 327 over the next week or two, maybe even sooner. Now, there's going to be tons of catalysts coming up related to inflation data, related to the labor market and the job market, specifically over the next 2 weeks. So make sure to put your seatbelts on. It's going to be a very, very bumpy ride, right? And so for QQQ specifically, we're looking to see if we're going to get some type of a break, retest, and push higher. Okay. And if we ultimately have a look above and fail here and we break below this liquidity zone right here, most likely we could see QQQ head back down to the $300 territory, right? Now, IWM had a head and shoulders that's been setting up and it played out. All right, we actually hit the targets for the head and shoulders. And this right here looked like a liquidity grab to me. If you take a look, we also had bullish divergence, right? So if you're not familiar with bullish divergence, simply we have a low right here and then a lower low right here, right? So low and lower low. But on the relative strength index, we have a low and then we have a higher low, right? So we've been building relative strength as the price was dropping, okay? And we hit the head and shoulders target. And it looked like they stopped a few people out here because you can see this candle quickly came back up above on the daily chart. We also got a MACD crossover to the upside, which tends to be a bullish entry signal right at the same time, really there. And we had the bullish divergence, and we've seen IWM have a nice move to the upside. We have a gap up here to fill right around that 181 territory. So it is possible, if we continue some of this bullishness, we could see IWM get to 181, pretty soon. Okay. Now, since March 6th, there's actually been a divergence in the bond market, specifically in TLT and the S&P 500. So we have the S&P 500 here in blue, and then we have TLT here in orange. And this may be a sign that things could be going back to how they were, right? Typically, bonds were looked at as a safe haven for stocks, right? And when stocks would go up, bonds would go down. And when, bonds would go up, maybe stocks would be going down, right? Historically, that's why people have been attracted to it. There's the famous 60-40 portfolio as well. And you can see heading into March 6th, they were both trading relatively the same. And then once March 6th came, the S&P was going down, TLT was going up, right? And then S&P is going up, TLT is going down. So there's been this divergence here. And over the past week or two, we can see that they're actually back aligned, all right, right around since March 27th, March 28th. They're starting to trade a little bit in a line, okay, and starting to go back up. So it's going to be interesting to see. I've personally mostly been leaving TLT alone. I think I had maybe 2 or 3 trades on TLT since the last time. I did notice that we had this divergence, and so I was trading, based off of that, right? I was going long on maybe the S&P 500 while shorting TLT, and that was working. But then now this divergence is starting to disappear. So it's a little confusing, right? You don't have to force any trades. When I look at TLT, I'm typically looking at TNX, the 10-year treasury yield, as well as the S&P 500 to see how they're moving, how they're correlating. And if it's not painting a clear picture for me, then, I can, cut my positions, right? Take some small profits, take some small losses, and really just focus on some other things that have clearer setups for me, right? Now, this is TLT's daily chart right now. There's been many signals. TLT has been, relatively textbook when it comes to the different signals. Some of them signals are going to be divergences, like I mentioned before. Some of them are chart patterns. For instance, here we had a rising wedge. Okay, we also got a MACD sell signal where the red line crosses below the blue line, and then we had a double top. So we had about three things together right here, suggesting that we could get a strong move down. Then after that move down, we put in a double bottom right here. Okay, we also had an abandoned baby chart pattern, which is these three candles right here. Okay, we actually bought call options right here at the bottom on this day, and got very good returns, 80% returns on those. We had bullish divergence. We had the low, we had the lower low, then we had the low, we had the higher low, right? And so we were building that relative strength as we were forming a double bottom, as we were forming an abandoned baby, lots of bullish patterns. Currently, we have a cup and handle pattern forming here, and this is our channel for the cup and handle, right? So there is that potential, if we really get a strong breakout of this channel right here, this little trading zone, we could see a strong push up to the 109.69 area, potentially even up to 111. We have a daily gap up to fill on the chart around 111. That's what all of these blue boxes are. Now, the thing you need to be cautious of is on the way of this move up, we have three big gaps down to fill, guys. We have one here right around 102.50. We have another one here right around 99/100. And then we've got another one all the way down here at 95. So these gaps, they do tend to fill about 90% of the time historically. The big question is, when are they going to fill, right? So if we get a bullish breakout, it is very possible we could see this gap up fill first, okay? But if this is a failed breakout, look above and fail, there's a good chance we could come down and fill that gap right around the 102, 102.5 area. And if we break that 102.88 support level, flip that to resistance, then that's when we have the chance of filling the other two gaps down below as well. Now, I mentioned the MACD a couple times, right? We had all the different setups right here. The MACD also got a bullish crossover right here. So it was really about four signals at this given point in time to go long. And currently, if you take a look, we have some question marks right here. Rather than getting a sell signal and curling back down, we can see that the red line here has actually just started hugging and kissing the blue line. So typically when this happens, you can see it be choppy. All right. And if it's going to be choppy and continue going up and down like this, then typically you tend to follow the trend that was leading into it, right? Until you get a clear signal to the downside or a clear signal to the upside. All right. Otherwise, while it's chopping, we've been in an uptrend here. So it's very possible we could just have a choppy uptrend in the meantime. Okay. Now, these are some of the profits from the last week, some screenshots from some of the members in the Discord, right? And so some people are trading with larger accounts, right? And some people are making 5 figures in a day, right? We have $22,000 gains in a day, $24,000 gains in a day. Some people are trading with hundreds, right? With just a couple $100. Some people are trading with thousands of dollars. And we even have a couple millionaires in the Discord as well. So, if you guys want to be a part of the trading community, get access to all of our exclusive intel and data resources, we're much more than just a call out group, right? That's posting entries and exits. Although you can follow and you can see, some of the plays that me and the other admins are getting in and out of for sure. But it's really just a positive learning environment and a really good space to be your one-stop shop for all your market needs. Between all of the news bots that we have in there that are constantly posting and updating you guys on the news, to all of the data resources we have, like golden sweeps, we have dark pool activity, equity blocks, unusual options activity. We have a stock bot in there that'll give you any of the stock info you need for a specific ticker if you use it. So join the Discord. Link is in the description. If you use code Zackley, like the channel name Zackley Trades, you guys can get a discount on your membership. The discount code is Zackley. Okay, just all lowercase Zackley, like the channel name Zackley Trades. Enough about the Discord. I want to mention another thing here, XLF, which I believe I've showed this chart before, but if the banking crisis is going to continue worsening, right, and we get some bad news, let's say 3-6 months from now, there's a very strong possibility where XLF could see a scenario where it goes down to $26, potentially even $22, okay? And that scenario is going to be the Wyckoff method, right? So I've taken the charts here and aligned it. And if you take a look, it looks very, very similar to the Wyckoff method, right? We have the spring up here, distribution, and the breakdown, just as we do over here. Then we got the throwback above the breakdown trend line. All right, and we've started a pretty significant move down. We're starting to get this bounce right here. Okay, to me, this looks like exactly where we're at right now. Okay, you see this is a doji candle, and then you know, we start to go up a little bit right here, and here we had to move down. We got a doji candle. We're starting to move up a little bit. So this scenario doesn't have to play out, right? We could, you know, head back up into this territory right around 35, 36. That's very possible for sure. You know, and a lot of stocks that really aren't related to the banking crisis have been hit a lot when it comes to, you know, the financial sector as a whole and XLF. So we may be seeing some type of little bit of a rebound. But as I mentioned, you know, 3 to 6 months from now, if we start seeing more banks collapse, I really wouldn't be surprised if this Wyckoff method plays out. And it's very possible that XLF can come down and fill this gap here around 26, 25, as well as the very small gap down here on 23. Remember, I said those gaps tend to fill about 90% of the time. Historically, the big question is when, right? So you can't necessarily time a gap fill, and there is that 10% chance that a gap never fills. But in this bear market, in this brutal bear market we've been experiencing, we've been seeing many gaps down that have been needed to get filled for the past, you know, 2-3 years. They're starting to get filled now in the bear market. So this is something to watch out for, you know, and just be cautious of, right? I'm not telling you guys to go all in short any of this stuff, short XLF, you know, with your whole life savings, just rather trying to mentally prepare you for some possible outcomes and different scenarios that could come across the market based on some, you know, technical data. Now, what's some of the fundamentals that really could drive some of this, right? Well, let's look at the S&P 500's sector contributions to overall S&P 500 earnings. All right, and you can see here that financials, all right, believe it or not, the financial sector is actually the second highest weighting in 18% of the S&P 500's total earnings, right? Now, meanwhile, the forward PE ratios for regional banks, okay, have been cut dramatically, guys, like 60%, all right? They're at pretty much all-time lows here, back to the COVID lows over here, and March 24th is when this data came out. Now, the financial sector's forward earnings estimate have collapsed as well, right? So this is the regional banks ETF, or this is, you know, the forward PE ratio for S&P 500 regional banks, right? And this is the financial sector forward earnings estimates, right? And we can see here that they have absolutely collapsed, guys, taking a big plunge down. And, you know, a lot of that is priced into the market now, right? It's starting to be priced in, but, you know, when those earnings reports come out, people are going to be diving deep, deep, deep into all of these banks and all of their balance sheets. They're going to be taking a look at, you know, their treasury positions as well, especially after what happened with Silicon Valley Bank. So they're going to be diving deep into those and looking for any type of flaws that they can to find a reason to sell some of these financial sector stocks as well as the banks. Now, more than $200 billion went into money market funds since SVB went under. And this is huge, guys. And the reason being, we'll dive into it a little bit more in the next chart, actually. But take a look at this one. Almost $600 billion in deposits have left the bank since the Fed began to raise interest rates, the biggest outflow on record. So we're seeing $600 billion in deposits leaving banks since the Fed began to raise interest rates, and more than $200 billion of that went into money market funds since SVB went under, just in that time period. Now, this is a big part of the reason here, right? And so I'm going to dive into it for you guys, but there's been a growing divergence between the Fed funds rate and interest rates on checking accounts is increasing the risk of bank deposit outflows, right? And so we have the Fed funds target rate, and then we have the national average interest rate for checking accounts. And you can see, guys, I mean, this is like comical, right? We're seeing that the national average interest rate for checking accounts is just bare minimum, right? They're literally giving us the bare minimum. Meanwhile, the Fed funds target rate is just skyrocketing, right? And so each time the Fed fund rate is rising, we're really not being rewarded with that from the banks. The banks are actually, you know, taking a lot of the profits and keeping a lot of the high yield that they're getting based off of the Fed funds target rate and the elevated Fed funds target rate. Now, if you take a look here, this is Google Trends, and you can see money market fund is one of the top search terms right now. Okay, it is absolutely skyrocketed, and this chart pretty much tells you all you need to know regarding what U.S. depositors are thinking about in terms of alternative places to park their cash. Yes, search volumes have been increasing since July 2022 when short-term interest rates started to rise, but the spike since mid-February seems closely correlated with the FDIC's takeover of Silicon Valley Bank. Moreover, recall that Google Trends captures all domestic search interests, not just that of corporations or wealthy individuals. The interest in money market funds is widespread, right? So it's not just interest from corporations or wealthy individuals. This is truly widespread, interest that we're seeing here in money market funds. All right, now it is too early to have confident view on the implications of the current banking turmoil for the U.S. economy. Our baseline expectation is that reduced credit availability will prove to be a headwind that helps the Fed keep growth below potential despite the support from rising real income and better global growth, not a hurricane that pushes the economy into recession and forces the Fed to ease aggressively. The risks are clearly skewed toward larger negative effects, and we have moved our subjective probability that the economy enters a recession in the next 12 months back up to 35% from 25%. However, this number remains well below the consensus of 60%. So that pretty much wraps up today's video, guys. I do want to mention that I have been doing a lot more coaching calls and, one-on-one Zoom calls and Zoom sessions since I really started talking about it more in my videos. And, there's a lot of people out there, okay? Someone's always got it worse, okay? A lot of people are coming to me and they're in some really bad situations. They're down tens of thousands of dollars, hundreds of thousands of dollars, even millions of dollars, right? I've talked to people, multiple people down millions of dollars. So, if you guys are experiencing pain, you're not alone, okay? And hopefully some of these videos can help just give you guidance on some of the things going on in the market, some of the important data that you guys need to be paying attention to. If you guys would like a one-on-one session with me where I can, just go over some different indicators, or, help you out with some, personal lessons for anything that you guys are interested in learning, email me over at zachleytrades@gmail.com. That's zachleytrades, like the channel name, at gmail.com. And I'll get back to you as soon as I can. We can try and set something up and do a little one-on-one session. Okay, otherwise feel free to join the Discord. Okay, and you can always DM me, send me a friend request in the Discord, and that's pretty much where you'll be able to get the quickest access to me. And I'm very active in there, as well as the other admin traders. So appreciate you guys watching. Smash that like button, subscribe to the channel if you guys are new, and we're out.